Have you ever wanted to collect rent without buying $1 million flat, dealing with tenants, or fixing leaking taps at 2 in the morning? That's the power of REITs, real estate income for everyday Singaporeans. You own a slice of malls, offices, or warehouses, and in return, you get steady kopi money every few months. Today we're breaking down Frasers Centrepoint Trust, or FCT, one of Singapore's favorite Heartland mall REITs, and how it did for the 6-month period and full financial year ended 30th September 2025. Stay till the end, because I'll share a simple 3-step sustainability check for dividends, a quick valuation sense check, PB, yield, gearing, and how the Fed rate cut could sweeten your kopi money in 2026. If this topic helps you build freedom income, like this video so more Singaporeans can see it, and subscribe to Wealth for You. Hit the bell to stay updated. Disclaimer: all financial information in this video is downloaded from the SGX website and official company releases. This content is for education and information only and not financial advice. Always do your own due diligence before investing. Chapter 1. What is a REIT and why it matters to income investors? Think of a REIT like a landlord, but without the stress. Instead of buying a condo or shophouse yourself, a REIT pools investors' money to own income-producing properties, malls, offices, warehouses, and then pays you rent through dividends. But here's the key difference. REITs are legally required to pay out at least 90% of their taxable income back to unit holders. That's why Singaporeans love REITs. They're built for steady, reliable income, not speculation. You're not chasing hype stocks or timing the next bull run. You're simply collecting rent from familiar names like Gong Cha, NTUC Fair Price, and McDonald's, all while sipping your own kopi at home. So when people talk about passive income, this is one of the most practical ways to get there, earning rent without being a landlord. Chapter 2. About Frasers Centrepoint Trust. Now that we understand what a REIT is, let's zoom in on one of Singapore's favorites, Frasers Centrepoint Trust, or FCT for short. If REITs were kopi stalls, FCT would be the reliable one in your neighborhood that's always open, always steady, and always got queue. FCT focuses on Heartland malls, the kind of places Singaporeans actually go every day. We're talking about Causeway Point, Northpoint City, Tampines 1, Tiong Bahru Plaza, Century Square, Hougang Mall, White Sands, and more. They even own half of NX and Waterway Point, plus an office building, Central Plaza, that's linked to Tiong Bahru Plaza. Altogether, that's 10 properties worth around 8.2 billion Singapore dollars, a 16.8% jump from last year, thanks to new acquisitions like Northpoint City South Wing. And get this, the portfolio is 98.1% occupied. Excluding 2 empty Cineplex spaces being re-leased, it's basically 99.9% full. In other words, almost every shop space is earning rent. Rental reversion, which is how much rents go up when leases renew, came in strong at plus 7.8% year-on-year. Shopper traffic also climbed 1.6%, and tenants' sales rose 3.7%. Even better, the average occupancy cost, how much tenants pay as a percent of sales, is just 16.1%, still comfortable, meaning room for future rent growth. So, while the CBD is still waking up from hybrid work, the heartlands are buzzing. And that's FCT's secret sauce. Steady, local, everyday cash flow from places Singaporeans can't live without. Chapter 3. FY25 Financial Results. Alright, let's talk FY 2025 results, released on 23rd October 2025. Because at the end of the day, income investors like us want to know, how much kopi money are we getting? For the 6-month period from 1st April to 30th September 2025, FCT brewed up a strong set of numbers. Gross revenue, 205 million Singapore dollars, up 14.3% year-on-year. Net property income, $144 million, up 12%. Distributions to unit holders, $123 million, up 12.5%. And DPU, 6.059 cents, including a small advanced payout of 0.096 cents in May 2025. Now for the full financial year, ended 30th September 2025. Gross revenue, $389.6 million, up 10.8%. Net property income, $278 million, up 9.7%. Distributable income, $233.2 million, up 8.8%. And full-year DPU, 12.113 cents, slightly higher than last year's 12.042 cents. Not bad, right? Especially when borrowing costs are still high. Yet FCT still managed to grow both income and DPU. How did they do it? Simple. 3 key engines kept the machine running smoothly. First, Northpoint City South Wing acquisition added fresh rental income after its $1.17 billion purchase. Second, Tampines 1's upgrade finished in 2024 and started contributing more rent. And third, strong tenant mix across all the malls kept shopper traffic and sales climbing. All this while keeping gearing at 39.6% and an average borrowing cost of 3.8%, steady and manageable. So if we think in COPE terms, 2025 wasn't about fancy new flavors, but about brewing the same reliable cup. Strong, consistent, and slightly sweeter than before. Chapter 4. Valuation and Key Ratios as of October 2025. Now, let's take a step back and see how the market is valuing Frasers Centrepoint Trust today. As of October 2025, FCT sits at around 4.95 billion Singapore dollars in market capitalization, one of the bigger players in Singapore's retail REIT scene. It's not a small-cap challenger. It's a seasoned, established name that's been serving COPE money to investors for more than a decade. If we look at the price-to-earnings ratio, it's roughly 21 times, meaning investors are paying about 21 years' worth of current earnings for each dollar invested. That might sound high, but for a stable and predictable suburban REIT, it's actually quite normal. You're paying for reliability, not excitement. On the price-to-book ratio, FCT trades at about 1.04 times its net asset value, just a little above book value. So it's not a cheap bargain, but it's also not frothy or overpriced. You could say it's like your regular COPE from the Hawker Center, fairly priced, no gimmicks, and you know exactly what you're getting. In terms of profitability, return on equity comes in at around 4.5%, reflecting steady earnings power. And because it's a REIT, the focus isn't on huge profits, but on consistent cash generation to pay unit holders. Now on to the balance sheet. And this part matters a lot for dividend investors. FCT's gearing ratio stands at 39.6%, which is comfortably below the MAS limit of 50%. That tells us it still has some headroom to borrow for future upgrades or acquisitions without taking on too much risk. The average cost of debt is about 3.8%, down from the 4% peak earlier in the year, showing financing costs are easing a bit. Finally, the interest coverage ratio sits around 3.46 times, which simply means for every dollar FCT pays in interest, it earns $3.46 in operating profit. That's a healthy buffer, and it helps ensure distributions remain sustainable even if rates fluctuate a bit. So, putting it all together, FCT isn't a cheap thrill stock. It's more like your dependable Copio from your neighborhood stall. Not fancy, but steady, consistent, and satisfying. You don't drink it for surprises, you drink it for comfort. Chapter 5. Dividends and Sustainability. All right, let's get to the part that income investors care most about, the dividends. FCT has always been known for one thing: consistency. In financial year 2025, unit holders received a total DPU of 12.113 cents, slightly higher than last year's 12.042 cents. That works out to a trailing yield of about 5.5% based on recent prices. Looking ahead, analysts expect the forward yield to stay in the range of 5.1% to 6.3%, depending on how rental income and interest costs move next year. Now, if you're wondering when the COPI money drops, here are the key dates. Ex-dividend date, 31st October 2025. Dividend payment date, 28th of November 2025. So if you're a unit holder before 31st October, you'll be entitled to the upcoming payout, which will land in your account just in time for that year-end COPI treat. In simple terms, FCT's payout is roughly what you'd expect from a good suburban REIT: steady, predictable, and comforting. You're not going to get fireworks, but you can probably count on your COPI money showing up on time every half year. Now, let's look behind the scenes to see how sustainable these payouts really are. FCT generated around 242 million Singapore dollars in operating cash flow last year, while distributing 233 million to unit holders. That means it's paying out almost everything it earns, roughly 88% of its accounting profit, and just over 100% of its cash flow. Is that a red flag? Not necessarily. REITs are structured to pay out most of their income, and FCT has been very clear that its policy is to distribute at least 90% of what it earns. Management also prefers to maintain a stable DPU, even in years when borrowing costs are higher, to preserve investor confidence. But here's the trade-off. When you pay out almost everything, there's not much buffer left for surprises. If rental growth slows or interest costs rise again, that can tighten the margins. It's a bit like living off your full paycheck every month, comfortable when times are good, but you'll feel the pinch if expenses go up. So, the dividend is sustainable for now, thanks to strong occupancy and recurring rental income. But going forward, FCT will need to keep growing its cash flow from higher rents, AEIs, or better cost control to keep that payout level secure. In other words, the COPI money looks steady, but there's not much foam on top. Chapter 6: Future Prospects 2026 and beyond. So, what's next for Frasers Centrepoint Trust? After such a steady year, what's brewing in the pot for 2026 and beyond? Let's start with the good news, the positives. FCT's greatest strength is still its Heartland focus. These malls are where Singaporeans live, eat, and shop daily. Whether it's buying groceries, makan with family, or dropping by the clinic, these are essential trips. That gives FCT a built-in demand base that's far more resilient than downtown malls that rely on tourists or office crowds. The retail outlook in Singapore also looks steady. There's limited new supply of retail space over the next few years, about 1.2 million square feet from 2025 to 2028, which is only around 2 to 3% of total stock. That's like adding one more bubble tea shop in a whole mall, barely noticeable. So, with low supply and healthy household spending, rents should stay well supported. Then there are the asset enhancement initiatives, FCT's version of mall makeovers. Tampines. One's revamp is already completed and contributing nicely. Hugang Mall's AEI is on track to finish by September 2026, with about 80% of tenants already pre-committed. These AEIs don't just refresh the malls, they usually bring in newer brands, higher rent, and stronger foot traffic. On the sustainability front, FCT's management deserves a nod. Over 90% of its borrowings are now green-financed, meaning the REIT is aligning funding with ESG goals, which can also translate to lower borrowing costs over time. They've even installed solar panels and food waste reduction systems in several malls, so the COPI money you collect is coming from a greener brew. But of course, it's not all smooth copy. There are a few things to watch out for. Because FCT pays out almost all its income, there's limited buffer for shocks, whether that's higher interest costs, a dip in tenant sales, or any economic slowdown. And while gearing is comfortable at 39.6%, that's still close to the upper mid-range. So, management will need to tread carefully before making big new acquisitions. Also, as more of us shop online or order food delivery, suburban malls must keep evolving. The good news? FCT's properties have been actively adding experiences, like new F&B, entertainment, and community concepts, to stay relevant. So, if we sum it up, FCT's future looks steady, not spectacular. It's not trying to be the next big growth story. It's about staying reliable, keeping malls full, and giving unit holders consistent income through good times and bad. In COPI terms, you're not getting a fancy latte art REIT here. You're getting your dependable Kopi o Kosong every morning. Simple, strong, and satisfying. Chapter 7. Impact of the impending Fed rate cuts. Now, let's talk about something every REIT investor has been waiting for: interest rate cuts. If you've been following the news, the U.S. Federal Reserve is widely expected to start cutting rates in the next couple of months in 2025, after 2 tough years of keeping them high to fight inflation. So what does that mean for a Singapore REIT like Frasers Centrepoint Trust? Well, here's the simple version. When the Fed cuts, it's usually good news for REITs. First, borrowing costs come down. FCT's average cost of debt is now around 3.8%. But if global interest rates soften, that could dip closer to 3% in the coming year or two. And for a REIT with nearly 2.6 billion Singapore dollars of borrowings, even a small drop in interest rates can translate into millions in savings, money that can go straight back into distributions. Second, when interest rates start coming down, REIT yields begin to look a lot more attractive compared to fixed deposits. Right now in Singapore, most fixed deposit rates hover around 1% to 1.6% per year. Pretty modest returns. So when a REIT like FCT is offering a yield of around 5.5%, that difference starts to look very chic. The gap widens, and many income-focused investors naturally gravitate back to REITs for that extra COPI money boost. Third, lower rates often mean higher property valuations. That's because valuers use something called a capitalization rate, which tends to move inversely with interest rates. When cap rates compress, property values rise, and so does the REIT's net asset value. So in short, when the COPI gets cheaper to brew, lower interest cost, REITs usually smell better to investors. But of course, we also need to stay grounded. A Fed rate cut doesn't magically fix everything overnight. The pace and depth of the cuts matter, and FCT's performance still depends on real things: shopper traffic, rental renewals, and cost management, not just interest rates. Still, for patient income investors, a falling rate environment could be the signal that the long, high-interest winter is finally thawing, and that steady REIT income, like FCT's, might feel a little warmer again in 2026. Chapter 8. How to Evaluate FCT. The Smart Way. Now, before we wrap up, let's slow down for a moment and talk about how to think about Frasers Centrepoint Trust, not whether to buy or sell it. Because at the end of the day, smart investing isn't about following tips. It's about knowing what kind of investor you are. So, here are a few questions I always ask myself, and you can too, whenever I look at a REIT like FCT. First, are you investing for stability or for growth? If you're someone who values steady, predictable cash flow, then FCT represents the kind of REIT built for that. It's not going to shoot up overnight, but it's designed to keep your COPI money coming in quietly, every 6 months. Second, can you handle short-term price swings? REIT prices move up and down with interest rates and market sentiment. But for long-term income investors, the focus isn't on next month's price. It's on whether the rents and distributions can stay stable over the next 5 or 10 years. Third, does the current valuation fit your comfort zone? At around 1.0 times book value and a 5 to 6% yield, FCT sits roughly in the fair value zone. It's not a bargain bin deal, but it's not overpriced either. The key is to match it against your own return expectations, time horizon, and cash flow needs. And lastly, do you believe in the story of Singapore's suburban retail? Because when you invest in FCT, you're really investing in our heartland life. The malls where families shop after dinner, where kids meet friends, and where daily essentials flow in and out. It's not just property, it's part of our community rhythm. So instead of thinking, should I buy or sell, ask, does this fit my plan to be cash flow rich, not paper rich? If your answer is yes, then whether the market goes up or down, your Kopi money plan stays on track. Final thoughts. Be cash flow rich, not paper rich. At the end of the day, Frasers Centrepoint Trust isn't about chasing quick gains or predicting tomorrow's price. It's about something far more important, building steady, lasting cash flow that gives you time, freedom, and peace of mind. FCT's malls are part of Singapore's daily heartbeat. Families shopping after dinner, kids grabbing bubble tea, aunties buying groceries. These are the quiet, everyday moments that keep its rental engine humming. As income investors, our goal is to build a portfolio that can do the same for us, providing steady Kopi money income so we can live life on our own terms. Because being cash flow rich means your money is working for you, not the other way around. So if this video helped you see REIT investing in a clearer way, give this video a like so more Singaporeans can learn how to grow freedom income. Subscribe to Wealth for You and tap the bell for more CPF, REIT, and dividend insights every week. Until next time, stay steady, stay invested, and as always, keep your cash flow growing and your Kopi warm.